Hi everyone, Shiv Parekh here. I'm the founder of hBits.
Shiv, can you start by just giving a very broad elevator pitch of what is hBits?
Yeah, sure, Akshay. So hBits is basically a real estate fractional ownership platform, whereby at a very, one line, this thing, one can own a share in a commercial property, the same way one can own a share in a Tata or a Reliance stock and make the returns associated by owning that property. So generally, the properties that we look at are, commercial, which is basically office, warehousing kind of properties, where these are grade A constructions. You have long-term leases with grade A tenants. It could be an MNC, could be a large Indian corporate. Generally, these property values will, be 20, 50, 100, 500 crore. And with 25 lakh, one can earn rental income, which is generally 8 to 9%. And then along with appreciation, one can make 15 to 18% IRR.
Okay,
And
amazing.
obviously, its investment process is completely tech enabled.
Okay. There are multiple ways in which, as an investor, I can put money into real estate. Like I could directly buy a property and rent it out myself and whatever, or I could invest in a REIT, which is a real estate investment trust, and the third is fractional ownership. These are the three broad approaches to
Yeah, these are the broad ways
investing.
to own properties. Yes, correct.
So, just help me understand. Um, you are representing fractional ownership. How does it compare with the first two approaches, where I directly buy versus I invest in a REIT, and then third is fractional.
Yeah, sure. I'll give you a little bit of, the pros and cons of each approach. And there's obviously, uh, there's not like one is better than the other. There's always pros and cons to every way of investment. So, firstly, in terms of directly buying a property, generally with a ticket size of 25 odd lakh, you're not going to be able to own a commercial property. So, predominantly, it'll be a residential property, right? And the issues with owning a residential property as an investment is one, your yields are only 1 to 2%, your rental that you're going to get, versus in commercial, it's 8 to 9%. So that
Wow.
in itself is a large difference. Number two is obviously your tenant profile in residential. You're going to have to deal with, individual families or individual people who are renting your property, and you're going to have to look after the property management of the property as well. So obviously with that, there are a lot of headaches that come with that. But yeah, the main difference, obviously, over and above just the property management headache and leasing headache, is you're getting 1 to 2% versus 8 to 9%. So that in itself is the largest difference. In terms of fractional ownership in REIT, there, yes, the underlying asset is similar in the sense that in both cases you're owning commercial properties, office properties. So in India right now there are four REITs. Three REITs are in the office space, and one REIT is in the retail or the mall space.
For
Um,
people who don't know what is a REIT, can you just do a REIT 101? What
sure,
is a REIT?
yeah. So REIT is basically a way to own a share in property similar to fractional ownership, but the difference is REIT is basically like a mutual fund where you're owning a bunch of different properties across the country with a bunch of different tenants, and then it's listed on the stock exchange. So you can own one share in that specific REIT, which will give you access to owning multiple properties across the country with multiple tenants.
So
So
basically, a portfolio manager can list his portfolio of properties on the exchange as a REIT. That
correct,
would be
correct.
and
The
individual
minimum
investors
ticket
can
size,
buy.
yeah.
Hmm.
So the minimum ticket size to get into an asset size that has to be in a REIT is 500 crore. But practically speaking, with the costs associated with operating and running a REIT, if you look at the three REITs, generally they have market caps of 15,000, 20,000 crore, which means that you need to have a portfolio of that size to really kickstart a REIT. Which is why if you look at the four REITs existing today, it's either by the top five developers in the country, or either your Blackstone or Brookfields, which are global behemoths in the real estate space and have invested in a large way in India. So what's happened is these guys have, owned properties, developed properties, and now for them this is an exit option in a way as well. So effectively,
And
those are kind of the
for,
four REITs. Yes.
for an investor, is there a minimum investment size for REIT?
In REIT, it's I forget the exact investment size, but it's in the tens of thousands of rupees.
Okay.
So it's relatively low. It's either
Okay.
20 or 50,000, but around that range. So that's the access that someone gets when they are, investing in a REIT. Yeah. So yeah, it's a relatively low ticket size compared to direct property ownership. Um, and so obviously you get much wider access, or you're able to target a much larger segment of people. Although the what what the REITs have, to be honest, have not been able to do so well is, while the idea of REIT is to encourage retail investor participation, right? And if you look at the market cap of the three office REITs is about 55,000 crore. Really, the retail investor participation would only be about 10,000 crore. Um, so, predominantly it's been large institutional investors, whether it's foreign or Indian, that are, looking to invest in these rent generating assets. Because the incentive of the people who are listing REITs has not really been to go after retail investors. For them, it's just getting an exit, whoever gives them the best price. So yeah, while the ticket size is low, really the retail investor participation hasn't been seen that much in the REITs, in the Indian REITs. I'm talking about only the Indian REITs. Obviously, say REITs from the United States, I mean, there'll be hundreds of REITs, and it's a much more established and deeper market outside India. So that's a completely different ball game altogether.
Why is
Um,
participation low in REITs? I'm, you know, I'm of the opinion that uh, money flows where there is returns. You don't need to do marketing. If there is like risk adjusted returns, money will flow naturally there. So if REITs were offering good risk adjusted returns, money would have flown there naturally. If money is not flowing there, then there must be something which is holding it back.
so I don't necessarily agree that, as long as you have good risk adjusted returns, money will flow there. There's obviously a little bit of marketing and distribution involved. And predominantly, and now it's changing, but historically, distribution in India has always been done by, IFAs or wealth managers. So effectively, it's, what they are pushing to their customers, number one. Number two, yes, there's a grain of truth that the risk adjusted returns need to be, the right number. And the nuance, though, is that the first REIT in India was only listed in April or March 2019. So track record is also only 4 odd years old, or 4.5 years old. For someone to really make, compared to other, like, when people say stock markets, you get 11 to 12% and they go back 20, 30 years. You're able to have that history and comfort. So in the REITs, it's not been. I'm sure it will happen, and the depth of the market will be established going forward. So in that sense, the market is still nascent
Okay, yeah, four
in
years
India.
is too small to make an opinion. But what does a REIT give on an average in like within this 4 year track record? Is it like 15-16% equal to what you're offering in fractional or?
I think the difference is that the REITs, where they've gone wrong is, when they listed, because they are listing their own assets. They would have tried to maximize value for themselves. So they've not left as much money on the table for investors, as say in a fractional ownership, where for us, uh, it's not our assets that we are listing on the platform. We are getting third party assets. So that nuance is there. So it would be slightly low in the case of REITs. And other nuance is that REITs are, listed. So the price of the exchange is also guided a lot by overall stock market and how it's performing. Um, so traditionally, at least if you look at the US, again, um, uh, in India, the what's it called? The history is only 4.5 years. But if you look at the US, there is a good amount of correlation between stock market returns and REIT returns. So you're not really getting diversification benefits from the REIT. So yeah, in the REITs, there would be slightly lower than the 15 odd percent. What's happened in the last 4.5 years.
I have a more basic question about REITs. Is it not like a mutual fund? Like a mutual fund lists their net asset value, and that net asset value is the value of your holdings. So that's not the case with a REIT. Like they must be sharing a net asset value that all my properties together have this much value divided by number of shares gives this value, because it's a
Yeah,
fairly
but
objective way to measure.
yeah, but ultimately it's listed, right? So the difference is that suppose I'm owning a share in a REIT and you want to come in and buy it. Ultimately, whatever someone lists as a price, it's for me. If I'm happy with the price that I'm getting, it's a bid and ask, right? As it is in a stock market. So
Okay, it's not a
you have to
redemption like
you.
in a mutual
It's not a
fund you
redemption.
redeem.
No, it's not a
Okay,
redemption. So
okay.
so when you are coming in, you will need to see two things, right? You will need to see that the yield from day one you're getting is attractive, as well as the potential appreciation. So yield will be very clear. You look at the yield that's happened in the last 3 months. You study if there's going to be any escalation. You will calculate your yield. And as of today, generally the yields on REITs are about 5 to 6%. So lower than the 8 to 9% I mentioned, because a lot of the appreciation has been priced in.
What does yield mean here? Yield is the rent.
Effectively, effectively, it's a rental.
Okay, okay, okay.
Yes. Yeah.
And this rent is not given back to the REIT or investors. It just goes into
No,
the
REITs.
bank of the. Uh,
Yeah, so it goes to the investors, right? The investors that are owning shares in the REIT, and REITs
okay,
mandatorily have to distribute 90% of the income that they get.
okay. So it's a dividend income which you get if you own a REIT.
Well, how it's structured, it's effectively it's like dividend, but from a tax perspective, it's a combination of dividend, interest, and amortization of loan payouts. And the three or four listed REITs today have various proportions as to which how they are paying it out. But yeah, it's a monthly or quarterly payment.
And what is the tax implication? Is REIT a tax-friendly investment?
Again, it depends on the split between dividend, interest, and the principal repayment. Each have their own tax treatments. And all three of them have different proportions, or rather, four, three of them are office, have different proportions. Effectively, if one studies it, one of them is more suited towards HNI, retail investors, and other is more suited towards institutional investors based because of the form in which you're getting it in. But
The tax is
effectively,
paid by the REIT, like they distribute money post-tax, or it is pre-tax? Who pays the tax
no,
on the
exactly
rental
what I'm
income?
saying. They're three different streams, right? They are
Hmm.
distributing part of the 6% or 5% is distributed dividend, part is interest, and part is amortization of loan. So if it's dividend, it's taxable. If it's interest, it's not taxable because it's passed through. So it effectively depends on, and each three REITs have different proportions as to how they are distributing it. Well, I mean,
Okay.
see, this is
And
this is this is exactly the point, right? When we are looking at REITs versus fractional ownership, just to explain this to someone and say each REIT is different, then you have to look at the proportion that's coming through dividend, the proportion that's coming through this. Each separately, you have to calculate the tax incidence to finally calculate their next net tax, right? So even though say theoretically risk adjusted returns might be good, to even calculate what your returns are going to be finally, you have to really go into the detail. And it's also the time taken to study the investment, right? And this makes it a little bit complicated. While they're trying to simplify it, this makes it a little bit more complicated. And that's exactly where fractional ownership comes in, where it makes it much more simplified and much more streamlined for the retail investor.
okay, so in a REIT, the tax calculation is the investor's headache. They have to figure out what is the tax
Correct.
they need to
Yes.
pay on.
Yes.
Okay,
Yeah.
okay,
Yeah.
okay. So definitely not for retail investors then, or not for
Yeah.
a casual retail investor. You need to be a slightly sophisticated investor.
Yes. Yeah. Correct.
Okay, interesting, interesting. Okay, so how does fractional ownership work? Like, maybe you can give me a case study of one of your properties,
Yeah.
how, or maybe give a case study of the very first one you did. How did you launch your very first property?
Yeah, so just high level first. So REIT basket of assets like a mutual fund, fractional ownership. It's like you can picking and choose which stock you want to invest in, and you're owning a share in the property. So in terms of the first property we listed, that was a much smaller property than the sizes that we are listing now. It was about an 8 crore property. It was in the eastern suburbs of Mumbai. It was an office unit within a building. Tenant was, an Indian BPO, but we studied the balance sheet. Uh, you know, Zero debt on the balance sheet. Revenue had tripled in the last 3 years. Profit had tripled. So we looked at the credit worthiness of the tenant. They had a long lock-in. They had invested into the fit outs of the property. In terms of how it works, so generally what we would do is we negotiate with the seller of the asset for a certain price, and then we list the asset on our platform. Um, at which point, investors come in either through our direct marketing channels onto our platform, or through we work with a lot of channel partners, whether it's wealth managers, IFAs, real estate brokers, and they understand the nuances of property. It's all available in a streamlined way, right? You can see photos, you can see video walkthrough, you can see the financial model, you can see the other tenants in the building. We give an education of how that building is, what are the features of that building, how that micro market is doing. We give someone insight into ultimately what is your rent that you're going to, and capital value. Is it below the market rent? Generally, we look at below the market rent and capital value, so there's appreciation potential. You can study on the dashboard. You can look at the leave and license agreement. If you want to study, you can look at the title report, and we get a title report from a tier one law firm. We work with Shardul, Amach, and Mangaldas. So all of that,
Title report
is
is
available.
proof of ownership.
Title report is basically saying that exactly proof. So the current owner is the whole and sole owner of the property, and there's no third party claims, etc., that can come up later when I buy the property. So I'm buying the property from the rightful owner, and there's no litigation, this that someone might come up and say no, I had a stake in this property. So effectively, you want clarity that the person you're buying from owns it fully, so that you're paying the right person and he's selling it to you, he or she's selling it to you. It's a very important piece of owning any property, because ultimately that jeopardizes the whole value of your property if there's some issue in the title. And in fact, just to give an example, we've given up and not gone ahead with properties. And we have one example so far where there was an issue in the title. So we returned back all the investors their money, but built a lot of trust with the investors. So yeah, we do all of that, and then ultimately the investors will become, every asset is housed in a separate private limited entity, and investors become shareholders and CCD holders in that private limited entity as per the amount that they've invested.
What is CCD?
CCD is a compulsory convertible debenture. It's effectively a debt instrument. Reason is structured like that, right? So for example, if it's a 50 crore property and you were investing 50 lakh in the property, your 50 lakh would be split into 5 lakh investing in equity, and 45 lakh in the CCD or the debentures. The reason is structured like that is whatever rent comes into the private limited company is paid out to investors as interest in CCD. So in your hands as an individual investor, it's interest income. And reason we do it that way as opposed to pure equity is effectively because it's more tax efficient. Because whatever rent is coming in the company's books, it's an interest expense, so it's zero. And so there's just tax at your hands. If it was dividend, then there would be corporate or profit tax, at the company level, and then there'd be dividend distribution tax at your end as well as the investor. So that's why it's
Interesting.
structured that way.
When companies distribute profits, then there is double taxation which happens. One is the company pays tax on it, and the second is the
Yeah,
investors who receive the dividends
correct,
also pay tax on it. Whereas if you're
correct.
giving it back as interest, then it is a part of your expenditure in your P&L, so it reduces your
Or
profit,
for the
reduces
company,
your tax, and
correct.
it
Yeah,
avoids. Okay.
yeah.
So you're saying this is typical, like 10% equity, 90% as debentures or debt.
Generally that's standard market practice, whether it's in this fractional ownership model or funds that are owning properties. 1090 is kind of any 1090 2080 generally is kind of market practice.
Okay, understood.
Yeah.
Okay. Hmm.
So
Okay.
just one caveat, or like one interesting this thing which is kind of revolutionary for the fractional ownership industry, is this is the structure we follow today, but SEBI has come up with a framework to regulate this. So we've been in touch with SEBI since 2022. They came up with a consultation paper in May of 23. In November, in their board meeting, they kind of said, okay, we're giving a go ahead. Then they're calling it MSM REIT, medium, small, and micro REIT. And now we're waiting keenly for the final fine print to come. But we have some broad idea what it's going to look like. So now the structure is going to change, and it's going to. I mean, the structure becomes much more attractive towards investors, and I can talk about that. But it's a game changer for the industry.
Okay, interesting. Yeah, we'll come to MSM REIT. I'll make a note of it. So yeah, coming back to so this gets listed on your platform. Each property that is listed is essentially a new legal entity, right? And that legal
Correct.
entity would
Correct.
find a new set of investors, and some part as debt, some part as equity would be
Yeah,
invested in that
correct.
legal entity. Okay, understood. uh so okay, you listed it, and then what happened? The first 8 crore property.
So the first 8 crore property, actually the first one was, we had just started, right? And this is a funny story. This speaks to, when you start a business, how difficult or how hard it is, right? At that time, we had a team of 4 people, including myself. One person in marketing, 2 people in sales, and myself. Um, and we listed that property, and I wrote 1 to 30. It was like kind of a different office, but similar. We wrote 1 to 30 on the this thing because we needed approximately 30 investors of 25 lakh each to fill up the property. And I said, let's fill this up in the next 30 days. And by the end of 30 days, we had 0 investors. Um,
Okay. Mm.
so, because at that point, um, you know, for someone to trust a new company, where, I did have decent amount of educational pedigree, but still young, not that much gray hair. That for
How
someone
old
to
were
trust
you?
someone who, at that time, this was 2019, so I would have been 27. Yeah,
Wow.
27 then.
Hmm.
Yes. Yeah. So, and it's a completely new brand, not heard of it before. A lot of skepticism from people. They're like, good concept, good idea, but and it's not like someone's investing 10,000, 20,000 rupees. Someone's investing 25 lakh. So it's a large sum of money. Um, so although people, and the other thing was also market education at that point, and even as of today, people didn't know in commercial properties you get 8 to 9%. You speak to someone and said, what do you get in real estate? 1 to 2%, because the access to commercial was never there. So sometimes people are like, this is too good to be true also. Then there are questions about the structure. There are questions about how will my money come. Will you be capable to handle it? How do I know this is a good property? Obviously, I'd have my rationale, but skepticism was there. Ultimately, it became a function of just speaking to as many people as possible. So in about 6 odd months, we did finally close the property. And then that property we held on for a year and a half. Generally, we look 4 to 6 years, but this is a year and a half. And being in the market, we got an offer for that property, and we exited for our investors at a 17.5% IRR. And those
Wow,
investors all
amazing. This
reinvested, barring one, in next properties
17.5% is a mix of appreciation on the
and
price
rental.
plus the rental income. Okay,
Correct. Yeah.
understood.
Yeah.
Hmm, interesting. Okay, what gave you the courage as a 27-year-old to go out and tell some property developer that I will buy this 8 crore property from you? Well, essentially, to a developer, you're saying I will buy it, and then you find investors who invest with
Right.
you, right? So,
Yeah.
what gave you the courage to do that as a 27-year-old?
No, so I was, lucky in that standpoint, in the sense that the first property I listed was actually my father's property. So we had that base and that helpful. That's also how I got into this industry, into the commercial real estate space. So, which is why we also got, slightly longer to fill up the property. Um, so we had that, ability. Although the third property or the fourth property we listed, was a 45 crore property, where we were listing the property, and this was in COVID lockdown too. And there you have 45 days, 60 days to fill up the property. There at least we had that confidence and conviction because we had built up the base of investors. But even at that point, we were comfortable doing maybe a 15, 20 crore property, right? It's the velocity of sales. Um, so, but ultimately, you have to take that. The benefit of that property was an amazing property at an amazing price, right? ICICI Bank is the tenant. You're picking up at a COVID pricing, which was we picked it up, just to give numbers. We picked it up approximately 11,000 rupees per square feet. 2 years later, their transactions in the building at 16,000 rupees per square feet. So
Wow.
the courage is also knowing the market and knowing that if there's a good deal, you'll be able to sell it. And it was a great deal, that one. So then it becomes a question of making sure it's the right property, and analyzing enough properties, knowing how to analyze properties, and then analyzing enough properties, and then being quick to put an offer to the seller and closing it quickly, because good properties don't stay in the market for long.
All right, interesting. What happened from first property to fourth, the 8 crore to 45 crore journey? What all, like, you were four people in the first property. How did you build your go to market muscle? Because I'm guessing that is like a key strength of the business, needs to be the ability to get clients in, right?
Absolutely. So in fact, right, we closed the first property towards the end of 2019. Closed the second property in the beginning of 2020. And then COVID hit, right? So 2020, COVID hit. And that's when we focused on the properties that we had. And we're like, we have to make sure that we're getting rent on time for our investors. That was the primary thing. Um, and I think we were able to do that very well, primarily because of three reasons. So during COVID, 100% collection in rent, 0% delay, and primarily due to three reasons, right? One is because we knew, we made sure that the tenants were good and credit worthy before entering. So like one of the tenants had zero leverage. Number two is, we had strong leave and license agreements in place, right? With good force majeure clauses. So we had put in a lot of
So,
effort into ensuring that.
what is that term used? Leave in license.
Leave and license agreement. That's basically it's a rental agreement
How do
between
you spell leave
the
in?
LEAVE,
Okay,
leave
leave
and
in.
license, leave
Leave and
and
license.
license.
Okay, okay,
Yeah.
okay, okay, okay. Hmm. Yeah,
So
just tell me about this. What is this agreement?
this is effectively the agreement between the landlord and the tenant. So
Okay.
those are all the terms and conditions, how long the tenant is locked in for. I mean, obviously the basics are there: rent, security deposit, term of the agreement, lock in. But other clauses also, right? What happens if the tenant defaults? If there's a delay in rental, force majeure. So we had a very strong contract. And number three is we had the ability to, because we knew the market well, we had that ability to negotiate with the tenant in from a good standing and also show them reason, right? So we show them reason that, see, I know your employees are not in the office, but all your furniture, fit out, servers are in the office. And let's not do this, because if you look at your cost and all of these large companies that are occupying these, whether it's an IT company, banking, uh, their real estate cost would be less than 5% of their manpower cost. Forget their revenue. So it's like, why do you want to get in this headache? Because we have mandate from investors. So if you delay in rent, we'll have to then take a certain route, which we don't want to take, legal route, etc. So just let's be reasonable. We're going to be here for a long time, so we negotiated with them, and so we got 100% collection in rental. So that was our focus during the beginning of COVID.
Amazing.
Then yeah. Um,
Nobody used force majeure. I mean, force majeure was a term I think we all learned during COVID. Nobody
yeah,
used
so
force majeure.
it's no, they tried, but then it was a definition of the specific force majeure clause in each contract. And the clause that was in our contract, uh, was not to do if they're still using the office, right? Their furniture was still the office. Um, So in that sense, the office is still in use. They're saying if we're not able to use it, the force majeure is, the way it was structured is more of the office itself is destroyed because of a fire, because of an earthquake. That's generally how force majeure clauses, or at least in our case, that's how force majeure clauses. If the office itself is, destroyed because of an earthquake or a fire, then force majeure would be applicable. Here, the office is still there. It's because of, some government law. I mean, government law is because of the pandemic. But effectively, the reason you're not able to use it is because of a government law. And on the flip side, there were companies that could use their office if they were having an essential service, right? There were, like say banks had a certain amount because bank was an essential service, so you could use the office. Um, so it's obviously very technical, uh, but that's where the force majeure clause became very important, and the nuances of how that clause is drafted in each agreement.
And force majeure basically says if such and such things happen, then you don't need to pay rent, something like that, or
Then
you don't need to
yeah. So
pay
then it
rent.
depends. In some cases, they'll say you don't need to pay rent. In some cases, they'll say the agreement itself is terminated.
Okay.
So that depends on case by case what prior the parties would have negotiated. But yeah, generally it's either one of those two things.
Okay. Okay. Understood.
Yeah.
Okay. So yeah. So once COVID hit, you focused on collections and you managed to achieve 100% collections. And the sale also would have happened during COVID, right? You sold
So
your
sale
first property.
happened. Yeah, the sale happened in 2021,
Okay.
around March 2021, of that first property. So as we did that, first we were slow for the first 6-8 months, and then in October we started expanding aggressively. So then we started building up the team, the sales team. We realized we need more salespeople. And we realize we need more senior marketing talent. From a tech perspective, we are still working with a vendor, but we need marketing talent to be able to make sure we're running the right campaigns. Whether it's Facebook, Google, content marketing, and from the sales, also you need more salespeople to either speak to more channel partners or brokers, or what's it called, or tend to the marketing leads. And then we also decided, I mean, that was a little early on, but we also realized that we needed a presence in Bangalore and the South, because this concept, has been more established in Bangalore and the South. Um, and even traditionally, before the platforms like us came up, people have been historically investing in this co-ownership model in Bangalore and the South much more than other markets in India. So we thought to tap that market as well. So we hired salespeople there as well. So effectively, that was the journey till we launched that next property in, say, it was in Feb 2021. We launched this 45 crore property, ICICI Bank and the tenant in Andheri. And then that it was a 60 days we had to close the property, which we pretty much did. But it was the experience during lockdown in April was kind of surreal. It's pretty sad, but there was a scenario where someone had invested the funds and then he passed away. So then you're dealing with stuff like, you know, luckily the allotment hadn't done, so we were just refunding the money to his, rightful heirs. But then we had to make sure that it was the rightful heirs, right? Because how do we know who it is as per the will? So we had to follow the probate. So it was those are the kind of challenges that you run into. So it was a very surreal experience during COVID, marketing this property.
Okay. And so property 3 was 45 crores.
There's a fourth property. Three.
Okay. Okay. Okay.
Yeah. Yeah.
And what was the third one? And when did you do the third? You did 2 pre-COVID, and the third
Yeah.
was
And then
during COVID?
and then third one was towards the end in December. Yeah.
Okay.
December of 2020.
Okay.
Yeah.
Okay. So, how much have you? I mean, the typical term assets under management may not apply here because you've
Yeah.
raised and exited for one of the properties. But how much have you total raised from investors?
Approximately 260 crore.
Okay. Okay. And out of this 260 crore, the first one has been an exit. Any other exits or just that one?
Just that one that we exited so far. But if you were looking at all the valuation of the properties, they're pretty much higher than the IRR that we've expected. So they're all doing well. We're just waiting for in that case we got a very good offer. And the reason we got a very good offer was also a small property, so there were more universe of buyers. Now we're waiting for 3 years to pass to get the long-term capital gain benefit to start exiting these properties or start going into the market for at least offers for these properties.
Yeah, okay. So if you have capital gain after 3 years, then it's half the tax rate, right? 10% instead of 20%.
No, so this is that probably for unlisted. For this is I'm for listed. For unlisted, it's 20% after 3 years with the benefit of indexation. If it's less than 3 years, it's short-term capital gain, which will be equal to your slab rate 30%.
Okay, okay. That's like regular income. Okay, understood,
Yeah.
understood. Okay, interesting. Okay. So, how do you, as a business, make money?
So we basically make a 1% yearly management fee, and then we make a carry at the time of exit. So we charge basically 15% over a 10% hurdle of IRR. That's how we make money.
Okay, understood. So, if a property returns 20%, so of that 20%, 10% straight away given, the remaining 10%, 15% of that, which is
So
1.5%,
one
you'll
and a
keep.
half percent.
The
Correct.
remaining will go back to the
Correct.
investors.
Correct.
Okay,
Correct.
okay.
Yeah.
And so far you've seen carry only in that one transaction, the 8 crore which got sold.
Yes. Yeah. Yeah.
Okay, how much did you earn in that?
So as in it was a 17.5% property. At that point, our carry structure was different, but it would have been about a percent or so.
Okay, okay, okay.
Yeah.
Understood. Okay, and you've raised funds also, right?
We've raised an angel round. Yes.
Okay, so what was the thesis you presented to the investors? Why did you decide to raise instead of just bootstrapping it?
So see, I think this is the kind of business that has a high operating leverage, right? So what I mean by that is that um, you have a certain amount of, see, my main costs are just my team costs and my marketing costs. So you need a very solid team, right? You need a very good in sales, very good in marketing, very good in tech, and very good in real estate acquisitions, and very good in operations to make sure, like, rentals are being dispersed, this, that, managing so many private entities. So you need a very capable team to manage this, and then you need marketing to obviously get more investors. Um, but the idea is that as your AUM scales, like say I'm at 260 now, I go to 1,000. I don't need to 4x my team size. Or to go from 1,000 to 10,000, I don't need to 10x my team size. So my fixed costs will remain the same. But my revenue is going to move proportionately to my AUM. Uh, the question becomes that at what point is your fixed cost and your revenue break even? And that happens when we are about 1,000 crore. So we'll only require funds to reach 1,000 crore. After that, you know, the business that we've done and the further business that we're doing on a monthly basis will fund, revenues will fund the cost. Um, so that's kind of the reason of raising funds. We can't be bootstrapped if we want to provide a certain level of service and quality to the investors. At the same time, it's not like a Ola Uber model where you need to spend unlimited amounts on marketing or a customer acquisition. It's not a burn model in that sense. Um, so we don't require boatloads of capital either. So that's kind of the way we look at things.
Okay, okay. And by when do you think you'll hit 1,000 crores AUM?
We have to reach it by the end of this year.
This
That's our
year. So
target.
you're saying you'll do three times what you've done till date. Till
Absolutely.
date,
No,
you've
absolutely.
done about 250. So you'll do three times that within this year.
100%. Yeah, yeah. Yes, yes. There's no question, right? Earlier, I mean, even if you look at, I don't want to give parallels, but if I'm not mistaken, I think DMart, I don't remember the numbers, I don't remember this thing, but DMart, I think, took 3 years or 5 years to get its first 3 stores or 4 stores. And then they grew exponentially. You have to get your business model right before growing aggressively. So now we've gotten everything right, right? We know what kind of properties investors want. We have a good enough team that's now sourcing enough assets to make the right proposals and offers and get the right properties across the country. we've built up our sales team to a level that can do that velocity of business. We have sales training in place so that new people who come in know what to say to investors. We have our CRM in place so that we can track how efficiently and quickly we are selling. We've tweaked our marketing campaigns so that we know that we are marketing and getting customer acquisition at a certain level. Right, it's very easy to burn marketing and spend more than the investor is going to give you. We didn't want to do that. We wanted to have a marketing campaign tweaked. So now all of that is just a question of instead of spending X on marketing, spending 5X on marketing and just getting 5X the number of investors. But the cost is still profitable. Uh, our website is completely built up with all the features that investors want. So, and the team is in place, right? Last year, we focused on bringing up and getting a lot of senior people onto our team to take charge of these functional areas. So we have a CTO on board. CTO is, IIT Bombay dropout because he started something, worked at companies like Farmeasy, Topper. We have a CFO who was heading global sales for Nomura. He's my co-founder now as well. So he's a chartered accountant. I am Ahmedabad grad, 30 years in banking. We have a head of sales who's worked at companies like Citi, HSBC, and Savills on the real estate side. So we have the senior team now in place to accelerate and reach those targets. So I guess the difference would be in a traditional startup model, one would tweak everything and then raise their Series A or Series B to accelerate growth. We've tweaked everything and then gotten senior people on board to accelerate growth. Because for us, it's
Okay, very
human
interesting.
capital, not monetary capital.
Right. Very interesting. Do you also need to do property management, or is that a outsourced function?
So see, in terms of property management, there are two parts to property management. One is facility management and one is lease management. So facility management would be, managing the elevators, managing, the housekeeping staff, the security systems. So right now we've taken office units within buildings. So that's managed by the society, hires a agency. Even when we take full buildings, we'll just outsource that and we'll just oversee it. So that we're never really going to get into facility management. Lease management is definitely a core competency of ours and it's very important. That's why we had 100% collection in rent during COVID. If and when the tenant leaves, releasing the property, negotiating with the tenant, that in fact is a differentiator between us and other players. And so we definitely do that. And it's a very important facet to do. Because ultimately, what determines your return is that contract between your tenant and the property. That is what
So,
determines your returns.
lease management is essentially a legal function. Like there would be a team of lawyers who do that, or
No, it's not just a legal function. It's basically a real estate function in a way, specific real estate function, right? So, lease management involves obviously there's operations, which is collection and rental, invoicing, which is very basic. If and when the rent is delayed for whatever reason, escalating it to the right channels, talking to the right person, understanding why it's delayed, and sorting that issue out. So that's a very kind of, it's not legal. There's a commercial angle to it. If and when the tenant is leaving, first understanding why they are leaving, trying to retain them at a price that works for you. If it's not at a price that works for you, understanding the market, understanding that, okay, I will be able to fetch X rupees rental in this property from a good tenant within, say, 3 months. So having that connect with HR heads, admin heads of a lot of these MNCs, having connects with your brokers, your JLLs, Cushmans, who are predominantly paying this office broking market. Then after that, negotiating with that tenant, both in terms of pricing and in terms of agreementation. All that, the legal function is one part of it. There is a good amount of legal involved, but it's what you do with that legal effectively and that market knowledge. That's where the lease management comes in.
okay. Uh, is it more important for you to have a marketing muscle, like acquiring customers, or to have property acquisition muscle, like acquiring good properties?
So I would say from day zero to where we are today, acquiring customers was important. But I think going forward, as the market is maturing, people are learning about it, people are getting interested in this, then it's going to become property acquisition and property management. As the industry sees, you need to have good products to give to your investors and make them good returns. Which is why if you compare our AUM to a couple of other players, it is lower, but because we've been very selective in the kind of properties we give onto our platform. Because, like you said earlier in the conversation, ultimately the differentiator between the players will not be your AUM, will be your what returns have you provided to your investors. Uh, that's what ultimately people will look at.
Okay, interesting. How do you build property acquisition muscle? Is it just through connections with brokers?
Connections with brokers, connections with developers who are selling properties. So that's number one. Once you have the connection, also it's um, responding very quickly to the offer, because what people don't like is they send you an offer and you don't say anything. Either responding yes, no, if no, what are the reasons? There's constant communication. Once you respond quickly, if it's a no, there might actually be a solution, and then having a very solution oriented approach. Like, for example, we gave, this is a very basic example, we gave a no because there was no lock in, right? We wanted a lock in from the tenant. The seller was like, okay, let me negotiate with the tenant. Let me figure out if I can get a longer lock in. We did that, and then we took the property onto the table, right? So being constant connect, basically it's executing on the basics very well, having an organization where you can execute on the basics very well. But that in itself, getting the basics right is something that is not that easy, and not a lot of companies do that very well. So having that execution capability to be on top of it. Then it's also understanding the market in terms of what is the right price to pay for the property, right? So we look at each and every sale transaction and each and every leave-in license transaction that's happened, in the recent past, to ensure that we are paying below market capital value and rental. Looking at other clauses of the leave-in license agreement, having that historical experience as to what can go wrong. So what clauses in the leave-in, because now we are not signing a new agreement with the tenant. You're just taking the agreement that was already signed by the prior owner over, right? So you can't really change too many terms. So understanding that what is a must have and a non-negotiable, and what you can live with, and especially as you scale, as you want to get more properties, uh, one, we have to increase our sourcing. So we are sourcing about 2 to 3,000 crore properties per month. But even
That's
after
a
that
massive
sourcing,
number.
yes, yeah. How do you filter down? How do you negotiate for so many properties parallelly? Those are the facets that come into play. And then there's also while the lawyers do play a role in the title report, there's other parts of due diligence as well, right? There's your technical due diligence, making sure all the approvals are in place, making the building is, up to standard. There's the commercial due diligence of the tenant. Is the tenant have the credit worthiness to the payer, to study the balance sheet of the tenant? Sometimes tenants might have a good brand name, but still not be credit worthy. So those kind of facets come into play as well in terms of property acquisitions.
Okay, interesting. So, who looks after property acquisition? Like you have a CTO who looks at tech, you have a CFO who looks at compliance, finance, accounts
Yeah.
receivable. Who
No,
does
so
acquisitions?
yeah, so we have someone senior on the real estate side who's come from, your IPC world, Cushman, you work at
Okay.
Cushman, CBRE, but that's where I myself personally get involved. The
Okay.
CTO, it can be a conversation, few times a week. I mean, we speak more, but here it's like I'm part of the negotiation meetings with the seller of the asset.
Because this is like
I
a
mean, that's
make
my,
or break.
yeah,
These are
exactly, most important
irreversible
function.
make or break decisions. Yeah. Yeah.
Yes, yeah. Everything else you can tweak and improve. This one, once you
Yeah.
list a property, then your
Yeah.
investors' hard-earned money is going there. So
Mm.
I would say that's where I'm personally involved.
Okay. So,
Yeah.
you are doing HNI sales, right? Somebody investing 25 lakhs is essentially an
Correct.
HNI. Can you share how to do HNI sales? How did you crack it? What works? What are your acquisition channels? You also mentioned you have other channels besides digital. So, just help me understand how you cracked HNI sales.
See, I think there are two parts to it, right? One is the ecosystem you build, and other is the actual, sales, this thing. And which is why I think initially it was so challenging, because I could be as good as I wanted in sales. If the ecosystem is not there, you're not going to be able, by ecosystem, I mean the brand of the company is not there, you're not going to be able to sell. So
Like
first,
the
that trust.
proposition, you're saying the proposition needs to be compelling before you
No,
go out
not
and
the
try to sell it.
proposition. No, no, not the proposition. The proposition, I mean, I'm not even mentioning that. That has to be compelling anyways, right? That goes without saying. Um, it's the trust in the brand. Like when I started first, uh, like I said, no one knew about us. Who are you? Why do I give you 25 lakh? So now, and what we did in the journey, right? We started working with the best partners, right? So work with Deloitte and PwC in structuring, Shardul in terms of legal, JLL in terms of valuation. Once we started closing properties, we started getting customer testimonials, putting them on the website, or that time even connecting investors to existing customers. Basically, in some way or the other, creating trust that you are a credible player, right? So even before the person talks to you, if they Google you and do a little bit of research, they have faith that you're not a fly-by-night operator. I'm talking about the 0 to 1 journey. You're not just someone who's there to make a quick buck. And there are enough stories like that in the country where I mean, effectively, there's so many frauds in the country as well. So who do you trust, right? And trust, there are two levels of trust. One is integrity trust, right? Is the guy a thief? And number two is the capability trust. Is the guy capable to deliver on what he's saying? And you have to first obviously solve the first one, and then solve the capability trust. So which is why the first part of the journey is extremely difficult, right? 6 months to close the first property. Now we have 260 crore in AUM. So being part of industry groups, just being out there speaking to people, creates that comfort. Now showcasing where our properties are at mark to market valuation, how our investors have performed. So all that obviously is part of the brand and ecosystem creation. Even showing walking through investors in terms of what kind of analysis we do in terms of property acquisitions, really being completely transparent that this is how we analyze properties, this is the number of properties we looked at, this is why we rejected these properties and we took this property.
And
So being
this is
completely
to
transparent.
build the capability trust by showing your process and how
Yes,
you do it.
yeah, correct,
Mm, mm,
exactly.
mm,
So that helps build the brand. Then in terms of actual sales to an investor, right? And I say this coming from the part that the first, I don't know, 50 customers I personally sold, right? Because that's what you do as a founder. And there, it's not too different from what people would say, but at least from my experience, is you keep your first, pitch short. Sometimes, people tend to drag on. So 5 to 7 minutes, sell your proposition. In this case, we're also selling the property. So sell in the first 5 to 7 minutes, and then just listen and answer questions, and also don't hard sell, because someone will always be like, why are you hard selling? And sometimes it's relationship building. We've had investors, and my salesperson himself has told me the investors that he's spoken to, one of our earlier salesperson, he spoke to 2 years ago, and now he's investing, right? So just some people will be ready to invest initially, some people will not. So your skill set is not to hard sell. Your skill set is to do your role of selling. And then if you're not getting that sale, then you have to expand and speak to more people. You don't hard sell the same person. Instead of talking to 10 people in a day, you talk to 50 people in a day. You just increase the size of the funnel. Um, that would be, that's what my learning is. Because I think hard sell people get, pushed back. And you also tend to make promises that you're making the promise to sell, not the promise that you can actually keep. So, we never want to overpromise.
very interesting. And how do you increase the funnel?
We increase the funnel through two ways primarily, or now three ways. Initially, it was 2 ways. One is you spend more on digital marketing and you get more leads, and then you try and reduce your cost per lead through various means. That's one way to increase the funnel. Other is, which is a more cost-effective way, is to cold call IFAs, and there are lists of IFAs available for very low cost. I mean, even someone
An
starting out,
IFA is a independent financial
independent
advisor,
financial advice. Yeah. So
which
either
could
you
be
use your network.
a CA or like somebody who's a mutual fund distributor or any such kind
Correct.
of people.
Correct.
Okay.
Correct. Or for us, IFAs or real estate brokers also. So either you use your network, but if you're starting out on your own, uh, you just have to cold call. And there, in a way, it's fine to cold call, for it's also business, right? For them, it's new business. And a lot of IFAs be like, no, it doesn't make sense for me. And there are IFAs who didn't make sense for 2 years ago who are now distributing for us, right? As the scale is built. So it's just, it's not rocket science. But I think where people lag behind is sometimes people want the quick and easy solution and are not willing to put in the hard work required, right? I mean, if someone makes 50 IFA calls a day and someone else makes 100, then naturally the person who's making 100 and pitch being the same, naturally the person going to be 100 is going to yield more results.
What is cheaper for you, acquisition through IFA or acquisition through digital?
It's kind of the same, right? Because acquisition through IFA is ultimately you to calling the IFA, meeting the IFA is free. Effectively, it's just your time. But ultimately, when the IFA gets a customer, then I have to pay a fee to the IFA.
You pay a fixed amount or a commission on amount?
No, it's a commission. It's a commission. Yeah. Yeah.
Like a few basis points, like
So
20, 30 basis points or something.
no, it's more than that. Generally, 2 to 3%.
How do you afford 2, 3? Because you're charging 1% annually on what an investor is putting in. So you're paying out of
Right.
pocket for.
No,
Uh,
so 1% we charge is our fee, our profit, but we also there's a price upfront, which is the acquisition fee of 3% from the investor, and that we pass on to our IFAs.
okay, okay. So there's
Yeah,
a entry load.
there's an entry. Yeah, but that's
Okay.
not as in we don't make that. We pass that on.
Yeah. Okay. So
Yeah.
so both are same. Like in both cases, it's about 2-3% of the
Yes.
amount
Correct.
invested that
Yes.
your cost of
Yes. Yeah.
acquisition. Okay.
Correct.
Okay.
Yes. Yes.
And will this go down at scale? The
Um,
IFA probably will
that's
not
the
because that is a human being. He wants his commission. But
yes.
will the digital go
No,
down
so
at scale?
the difference. No, sorry, I will say that even with the human being wanting his commission, as the product gets more established in the market, the sales become easier. The time taken to sell becomes easier, right? So if the guy took say 1 hour to sell and now he's taking 30 minutes to sell, I'm just talking very theoretically. With the
You can
same time, he
renegotiate.
can sell two customers. Yeah, so he's measuring his time
Hmm.
per sale, right? So theoretically, it could go down. Uh, whether it will or not, we'll see. I think it will though. And the other thing is the ticket size also is coming down, right, with the new SEBI regulation. So
Okay. So let's talk about the new SEBI regulation, the MSM REIT. Just tell me what is
right.
that all about? How will it change the structure?
So like I mentioned, this is SEBI's taken note of this industry growing, and they've taken a very positive view. We met them in 2000, like last year, and they wanted to formalize it. So um, it's a different structure in the sense it's a trust structure, and you as an investor will own units of the trust, but different units will represent different SPVs. So you can pick and choose which asset you want to invest in. It's going to be listed, so the tradability of your share becomes even easier. The minimum ticket size is 10 lakh. And what's mandated is you can take properties between 25 crore to 500 crore for each SPV that you're listing. There are obviously other nuances. They have, certain experience criteria for the manager being a platform like us, certain net worth criteria, a certain amount that one must invest in the property as the manager. So all those parameters are also there. There's certain disclosure requirements. There's a half yearly valuation requirement. And given that it's regulated by SEBI, we believe a lot more people will get comfort in investing in this asset class.
But this would increase your cost of doing business. It sounds like it, purely because of compliance costs increasing, and you would probably need to raise more funds if there's a net worth criteria as
See,
well.
net worth we'll need to raise, and that's just to keep as net worth. But in terms of otherwise cost of business, we're pretty much doing what they are mandating anyways. Instead of following one structure, we're following another structure, where NA is getting valuation reports, where NA is disclosing more than what SEBI is mandated. Yes, the net worth requirement for that we need to raise funds.
Okay. Interesting. Amazing. Cool. Any words of advice to young aspiring founders on how to scale and build?
Um, I think I'm maybe repeating myself a little bit, but I think grit and perseverance is underrated. Right? When I was naive and I thought that I'd fill in the property in 30 days, took me 6 odd months to fill in the property. If I thought from a very theoretical perspective, I would have thought, what's going to change, right? What I've been doing the first 30 days, why does it change in the next 30 days? And then you just quit. But sometimes you just have to have faith in yourself, faith in the idea, and then keep moving forward.